Hi, sir. Apologies for the inconvenience. So, guys, without wasting any further time, let me take a moment to welcome our guest for today. Today we have Aveek Mitra, sir, SEBI registered investment advisor. He's a co-founder and CEO at AVEKSAT Equity, and he has overall 23 years of experience in industry, and he has also appeared on ET now on various occasions. Previously, he had worked in L&T and Usha Martin, and also served as a CEO of a small company which later became a medium size over a period of 12 years. And he has been investing in markets since 1996. But initially, it was a part time passion, but he became more serious from 2002 onwards. And in the year 2003, he returned to India and started Aveksat Equity in the year 2016. And for your information, in the last 7 8 years, the Aveksat Equity Advisory has generated 30 plus percent of CAGR, and that's very commendable. They also publish 6 monthly audit reports to ensure that they are disciplined and focus on their key objective, which is to protect investor wealth. And they do not believe in one particular style of investing. For that, they evolve as the market situation is, and because no style can work across cycles, so it would be wise to understand these cycles and invest accordingly. And as far as education is concerned, he did his graduation in physics, and he is an MBA from IMT Ghaziabad. Also done advanced management program from London Business School, and investment and valuation certification from ISB Hyderabad. And as far as his interests are concerned, so he has a varied. He read about spirituality, politics, and has got a very good taste of music and cinema. And he basically divide his time equally between Delhi, Kolkata, and Washington DC. So a very warm welcome, sir. And in case I missed something on your introduction, so I would request you to add, please. Yeah.
Yeah, thanks everybody, and good evening to all. And I hope it is good for most of the people who have joined from India only. So good evening. Otherwise, good morning, good afternoon, or whatever time zone you are in. I think Prince has given a good introduction. Only one correction is that I came back to India in 2013 and started this equity advisory and portfolio advisory service in 2016. I've been investing since the year 1996, but I had very little money. So I think this a little bit of earning I started making after, say, maybe 2000, 2001. And I had a good cycle in 2003 to 2008 period. And then also had the learnings of 2008 onwards. 2013, when I came back to India, I decided to manage my own money. Then later on, to be more disciplined, I started this equity advisory and portfolio advisory. And with God's grace and the other investors and members who have joined us over a period of time, we have kept our interest and focus on, and we have generated, I think, a reasonably good return in a disciplined way over the period of time. Not that we have generated very uniform rate of return, because 2020, you all know that everybody had a bad year, because when you are auditing your result, you have a cutoff date, and the cutoff date for everybody was 30th of March 2020. So on that basis, actually that year our performance was poor. But equity advisory return was about 30%, but portfolio to portfolio return varies. So uh, portfolio to portfolio return will always change depending on what time you have joined and what time you have started building your portfolio. So having said that, so I think the heading which Prince kept for today's is that how to generate multi-bagger portfolio. Now I actually haven't thought about the particular subject line, but when I got the subject line from Prince, that how to generate how to make multi-bagger stocks or something like that, then I actually kept in my mind that I never look for multi-bagger stocks. I generally try to look for multi-bagger portfolios which generate a steady return with reasonably manageable volatility over a long period of time. So if somebody is looking for, we generally tell that if somebody is looking for multi-bagger stock ideas and things like that, we may not be the right persons, because for multi-bagger stocks, there are certain kind of characteristics required for initial investments. If we follow that for entire portfolio, then the portfolio volatility and portfolio return can go very wild. And as a serious investment advisors, we cannot do that. And we generally try to see that across cycles we generate a return, and that is how we have generated a multi-bagger kind of portfolio. I think at least 15-16% to 30-35% return across the portfolios we have generated. So I can take a few minutes to talk about how we look into the investments and how we start. So primarily when we get equity advisor is a very simple thing which we do. That is, whenever we find that a very good opportunity is there in a particular stock, and we feel that that can be added to the investor based on his risk appetite, then we make an investment. So that is a small part of our business. Our main part of our business is portfolio advisory service to HNI, NRI clients and family offices. There, actually, we try to first analyze the risk profile of the particular entity or the investor which we are looking into. And then we create a portfolio basically trying to see that what is the kind of expectations and risk profile the person has. And there are two kind of businesses primarily if you look into that. One is the growth kind of stocks, and other is the free cash flow generating stocks. So if you I generally broadly define and decide the two sectors, that one is free cash flow generating, high ROE, high ROC kind of a businesses, which is having a medium kind of growth, say like Indian FMCG, Indian IT kind of stories. And there is the other sector which is the growth stocks, where we say it is the new age companies, or QSR, or some kind of footwear or fashion or health and well-being, or some kind of mid-scale growth with a free cash flow kind of stories, like say kind of furnitures, or what's I furniture means that I think the ceramics and building materials, and say your uh, a kind of domestic based pharmaceutical company, which will be having a medium size of growth and medium size of cash flow. So we try to mix it based on the risk profile of the investor. And at the same time, we are not really focused on particularly buying and holding something, because I think there are three four kind of things which we look into basically while we invest. So one is that what is the kind of cyclicality of the business. So there may be extremely short cycle businesses, like for example sugar, where we don't invest because we don't understand, and we don't want to risk investors money, because we can more often go wrong than right in those kind of cycles. And we have seen that it is not our expertise area. Whenever we have tried it, we failed there. The second is the medium cycle kind of investments. And medium cycle examples may be some kind of commodities, some kind of I think you can. I just can't really think through it right away, but you can think through. And there are certain kind of long cycle. So long cycles are like industrial, capital goods, and say every cycle, every business has go through a business cycle. So long cycle I would consider as those companies which having a cycle which is more than 6-7 years. Like say presently we are seeing a surge in the capital goods sector, so, or say the industrial sector, so that starts on a 10-year gap and maybe remain for 4, 5, 6 years. So we try to focus there. Other is the kind of thing which are export dependent or domestic dependent. So that is a broad way basically we try to generate where all to look into for deciding on a top down level on a particular uh, set of stocks which we want to invest in. And then we for allocation part, next come is that allocation part. And allocation we decide on a our proprietary system which we are developing right now. Basically it is not fully developed, on an algo based optimizer we are trying to develop, where we decide on the portfolio allocation. But at the same time our allocation never goes beyond say 5-6% in a particular stock. And also that goes with the size, because we manage portfolio ranging from 50 lakhs to 30 crore. So keeping that in mind, we have to decide how we make the allocation. And the third is that when we enter, we try to enter it seeing a bit of technical thing, that whether the stock is looking technically on a long range uptrend, or it is on a downtrend, or whether it is on a sideways movement. We try to time the market, you can say roughly maybe 60-65%, and for a part of the portfolio. And for a part of the portfolio we go for, actually when the stock is down, we know that business is good, and the stock, and we can accumulate it slowly over a period of time. And the investor expectation is also that okay, he can wait, he wants the CAGR, not a kind of a year on year return matrix. So that time we accumulate that kind of stocks over a period of time, but that is basically for family office kind of portfolios, which are not individual types. So that is a large size portfolios. So that is primarily we go about to investing. That is, as I said, that we decide the business on the cyclicality part, then on the whether it is asset heavy or asset light part, whether it is export dependent or domestic, or it is spread between the two, and which sector is showing the kind of strength, where the technical analysis is giving me some support, and the allocation is decided on uh, some kind of an algorithm which works most of the time, and which we are constantly evolving with more and more data. And then we make the allocation based on which sectors are working on, and which sectors are actually can provide a kind of counterbalance to that particular thing. But everything we do it knowing the investor profile or the investor expectation. It is not that we follow a one particular kind of an investment across the investors. So this is how we have actually generated this return. So I have just given a broad pointer, basically how we have been successful. If we consider ourselves as successful, then and I think we have done good. We have done good compared to, I think, many of the advisory PMS or portfolio mutual funds and things like that. But one advantage for us is that we are much smaller in size, so we don't manage some billions and billions of dollars. So that gives us an advantage and flexibility, and that part has to be mentioned, because if we don't mention that, then I do an injustice to others who may have generated a lesser return but manage a much larger portfolio of money. So this is primarily to start, and I think beyond this, if you guys start asking me questions, I will be more focused in answering that, rather than me actually meandering about subject matter which is very broad, very wide, very deep, which may not do justice to everybody who have joined in. So I would prefer to answer questions of all the people around than trying to give my own gyan to you guys.
You started part time in the year 1996. So what changed in those next say 6 years that you took it seriously in the year 2002? And if I were to ask like those 20 23 years, how things have evolved, because there are certain things, basic things which remain same, and secondly, as you explained just some time ago, that like things are changing and we have to be in sync with those. So how it has evolved for you over 2 decades, how things have changed?
Okay, so 1996 to 2000, you mean to say that I said that I invested, but I didn't have much money. So the point is that you can invest, but unless you have an initial capital to invest, then you cannot give that kind of an energy to investments. And I was doing a full time job, and and then 2002 onwards, I was outside. of India. I was based out of Singapore, running businesses in Bangladesh and Philippines and Singapore. So, and 12 years I was doing that. So that kept me busy, but at the same time, that gave me some kind of an ammunition to enter into the market in a serious way. That is number one. Number two is that I have actually made a investment in 1996, which almost halved, I think, in next 2 3 years time. So that time we were investing basically whenever I read something or somebody is telling something, or well, like everybody else does it, right? In initial days, and I made more mistakes than I made things right. And but then onwards, I think 1999 2000 onwards, I started knowing few people who have guided me to the right approach to investments, or actually guided me to some books. Some people, honestly speaking, I never knew the name of Mr. Warren Buffett till 1997 98 in a serious way. I knew that he's a good investor, he does invest, but what he wrote, what he did, and what are his these kind of stuffs I have never read before. So that way it started investment. Unless you have a certain amount of money, then investments exercise doesn't become a cost effective exercise. So that is why I said that 2000 onwards. And frankly speaking, if I tell a story, then the story is something like I left L&T sometime around year 99, and I got my PF money of some I think about 2.5 lakhs or something like that. And you can understand that after working for 10 years, I have earned that much of money only in my PF account. So and that money I've invested into Sun Pharmaceuticals, and that I have sold in 2016. Okay, so I hold it for almost 2000 to 2016 is all 16 years I have hold it on. And that was the investment I made basically through actually talking to people, talking to doctors, and own which companies are doing. I thought pharma would be a good sector, so that way I invested. So now your question may come that when you have that was a substantial sum of my maybe that was an 80% of my investment was put into that. Uh, but that time I didn't have how to I didn't have a framework to know how to build a portfolio, how to run a proper analysis of managing the portfolio part of it, which I started doing it from the year 2003-4 onwards. And I think I have become a better investor by the time I have faced the crash of 2008 in uh, in the market meltdown. So when I lost almost 40% of the money which I invested and gained over a period of time, over a period of just 6 7 months. But everything was recovered. So remaining in the market actually helped me, and that also taught me that you should be in the market rather than getting out of it. Else you cannot be able to really recover if you have got the rough edge of the volatility. We try to reduce the volatility, we try to reduce the kind of negative beta on the stock and the portfolio which we invest, but at the same time you cannot really escape it completely. But that has given me that learning that how to reduce the volatility more and more and more. So I always prefer a portfolio which gives me 20% return with 2% 5% volatility than a portfolio which is giving me 30% return with 40% volatility in between. So that's it. And second part you said is that how investment is changing. Investment has changed almost in a completely unrecognizable ways, because uh, basic fundamentals remain same and will remain same. It is like gravity, it will remain same. But point is that the fundamentals of investments, though remaining constant, the entire thing just beside that core has changed, right? The information dissemination, it has become instantaneous. Hundreds and people are actually pouring into the data, their analysis and their interpretations of the information and data is coming onto the social media and available to everybody. There is no age to anybody in that sense. And secondly is that the kind of disclosure norms and the regulatory environment which has become much better. And I think today our market, in spite of whatever every market Every market participant always have some complaints about something in the market. But having said that, I think our exchange, our regulator, our clearing system, our trust in the entire investment universe have increased manyfold, because in the 1996 and all, I don't think there were a trust. So everybody was scared for making investments, not because that the market stock will go down or up, but they used to see that their money will be lost and they will be cheated and things like that. There will be bad delivery, there will be signature mismatch, there will be lost certificate. So that the world has changed, world has completely changed. And at that time this annual report used to come, and once in a year you get to analyze, and that analysis used to happen, say, 3 months after the event is occurred. So from that kind of situation where we are today, where within 1 hour time everything is done, everything is set, and market will start giving you signals uh, from the next minute. So those kind of things have made investment much more interesting, much more challenging, and much more difficult for an average investor to invest. Now everybody thinks that with social media, following 500 people and reading 200 books, or some kind of listening to 500 people over Twitter, Facebook, or social media, or TV, or something like that, one can become investor. It is difficult because you need a lot of resources, lot of data, lot of manpower, lot of crunching, lot of thinking, and you need to have a passion for this. So that is, I'm not a person who believes that everybody can be an investor and everybody can make their own investment. So I may be having an opinionated view here. I can change my opinion based on informed debate, but I strongly view this. So did I answer your question?
Yeah, indeed, yes, sir. So we have few speakers with us. We'll go to them. Before that, I ask another question. So, sir, like you started AVEKSAT in the year 2016. So
Yes.
how this has led to, I mean, you coming to advisory services from a, I mean, you being in a very good job previously. So, could you please explain the shift, how you shifted to being a full time?
As I said, that I came back to India in 2013, and I that time I had decided that, and I was only 45. So that time I decided that I'll just manage my money and read books and listen music. But gradually I thought that it is much better to, to start something so that I can remain disciplined while I'm managing others' money. That is number one. Number two is that the question came is that if I start it, who will become my subscriber? Who knows me? Right. So actually I found that there is an answer to this, because I was reading and sorry, I'm writing and contributing to Value Picker Forum. I don't know how many of you are aware of it. That is one of the forum which started first, I think, many years back. I think in 2010 we have started this Value Picker Forum. So from that, there was a knowledge about my existence in an investment field, and also I knew a lot of investors and investor friends whom I actually guided and advised earlier, that buy this, sell that, don't buy this, that kind of way. I have created already a trust circle of, say, about 30-40 people who really have made it well over a period of 2003 to 2013 period. So that became my ready base of investors who started, and they're still with us. Our one advantage for us in AVEKSAT, I have found, is that our retention rate of clients are almost about 98%. So if people join us, specifically the people, serious people who have taken our advisory or taken our portfolio advisory service or equity advisory service, for a year or more, they generally don't leave us. What that 2%, 3% churn we see is that we have kept an option of 3 months advisory to let people audit our particular performances by going through our reports and things like that. Sometimes we find that there is a churn, because otherwise, if you have noticed, we don't promote, we don't advertise, or we don't do much about anything. So our reference clients and our existing clients actually give us a base. So I started because there was a value picker forum for which people knew me, and I started because I had actually 40, 50 people who were trusting me, because I used to give them free ideas earlier that to the friends, relatives, and things like that. So that is how it started, and then I think through it grew organically rather than in any other particular way. So did I answer this?
Yeah. So, Janak, Shashank, if you have any questions, you go. You guys can go first. Then we ask Saurabh for that.
Yeah. Shashank, you want to go?
Yeah, okay, I'll go first then.
Yeah, please.
Avik sir, first of all, thank you so much for your for coming to the space, and I've been following you on
Thank you.
Value Picker, and all your tweets and everything are very very insightful. And recently, I think you shared this book, Intuitive Investor.
Yeah.
That was, I think, one of the most interesting books I've read, and thank you for that. So
Yeah, so
my
I think I
question,
find that book very valuable to me. I think one of the
yeah,
most important book to me. I read it couple of times, and
I
incidentally, I
think
know the
because
person also. So the writer also, I know quite well.
oh, okay, I see.
Yeah,
That's really nice. So my
yeah.
question, Victor, is that you have seen both the worlds of fundamentals and technicals.
Hmm.
I just want you to touch like how you basically use these two strategies in your
Hmm.
current like portfolio advisory and portfolio construction. And secondly, whenever you make a decision, be it a
Hmm.
buy or a sell, what is generally the split between the fundamentals and the technicals that you give? Like, for example, if you're buying a stock,
Hmm.
what proportion of, like, let's say, like 40% comes from fundamentals and 60 technicals, and or like when you're selling a stock, how this split works? So, yeah.
Okay, so it will be a little long answer. So yeah,
Sure,
and
sure,
I I,
definitely.
I don't know
We have
whether
our time.
I'll be really answering it in a very cogent manner because I never have prepared for this answer. But this answer I know in my mind. So let me answer
Sure.
this in a manner like say, look, for us the fundamental analysis, the deep dive by our own into a particular company is very important before making any decision. Just because the stock is looking interesting and it doesn't make us excited about investing in it. Stock look exciting technically does not make us interested in the stock. That is what I meant. So now, after having done our research, and incidentally, we do cover a lot of companies because we are having about a 7-member team, and we cover a lot of companies. Uh, and keep it on our radar at any point of time, and I think that is work we do almost at an institutional scale, because an institution may be covering, I don't know, maybe 200-300 companies. We cover maybe 700-800 companies, but we have developed a certain kind of matrices to look into that, what to look into. To give an example, suppose I look into the building material space of space. I quickly run through the entire set of companies which are there. There may be about 20 listed companies, but maybe there are only 3-4 companies which is generating a higher EBITDA, higher sales, and they are the leaders. So we can quickly know that, okay, so there may be 20 companies, but these are the 2 companies which we need to study. So that is the kind of quick screener we run through either S Equity or Bloomberg or things like that. And after doing that, we try to look into the technical part of it. And the technical part, basically, we try to see that what kind of trend it is showing on a moving average charts. Like if it is upwardly trending with a good gradient, we make a little larger allocation. If it is a gradient which is not that steep gradient, but still actually having an upward bias, we make a little lesser allocation. So and this way we develop our portfolio. But that also we actually check it with all other sentiments and other yeah, the other parameters of that particular stock, like what is the liquidity kind of, what is the daily kind of have to sell and buy, because we want to be liquid. We are very scared of illiquidity, and if we are investing in an illiquid stock, we do it deliberately, knowing that I am making a 3% investment. I will hold it for 2-3 years, and I will sell it slowly. So for me, the present liquidity does not matter. So, with eyes wide open, we make investments into liquid stocks, and we make very clear uh, uh, decision in our head on this issue before making a commitment. And that too does not become more than 10-15% of the portfolio. We want to be liquid in an uncertain world. Number one. Number two is that after that, the allocation, as I said, that we decide based on certain kind of technical parameters and our faith in that particular company's growth, because ultimately we are making a growth investment framework in for investors, because for Indian investors, which we make just a free cash flow generating machine investments, like say I make an investments in an Hindustan Unilever or IT TCS or Infosys and something like that. I do not think that we will be able to generate more than 10-12% return over a long period of time, because free cash flow generating businesses sounds academically very interesting to talk about, and it can make investment gurus and gyanis in media platforms. But point is that to generate kind of return which I think our investors expect from us cannot be generated if we build entire portfolio with that kind of things. Now coming to the sales part. On sales part, we follow two kind of approaches. One is that if the stock is very widely followed, now we have found that our investments, everybody follows that particular investment, everybody knows about it, but the stock is not giving a set of return, then our there are certain parameters we follow and we sell it irrespective of whatever is our view. We never think that we know the best. We think market also gives us a signal that okay, if everybody is talking but even then the stock is not going, there is something either I am not understanding or market knows better than us. So point is that you get out of it, then think. Don't think and then get out. And that also depends on the another part, that is what is the present trend in the market. If the trend is volatile, we don't try to wait, and we just get out. One example I can give you is that we got out of Laurus Lab long time back when we found that the stock is really looking weak on the chart. Though we were having a conviction about that particular idea at that particular point of time, that okay, this will do well. I'm just giving an example. There are various examples of you selling. We made a mistakes also in selling and the stock has gone up subsequently. It has also happened, but that does not matter, because to us it is important that we try to see that investors money whenever there is a gain, because that was already a 5x gain for the investors, or 3 to 4x to 5x gain for the investor depending on the time we have invested in them. But we wanted to protect that gain. Protecting the gain is very very important for us, number one. Number two is that another time when we sell is that when we are on a risk management mode. Sometimes we feel that everything is fine, but we need to generate cash in the portfolio so that we can invest at the right point of time. Can you hear me?
Yes, yes, we
Hello?
can hear you. Yeah, we can hear you.
Hello?
Yeah, we can hear you. Carry on, sir.
Hello?
Sir, you are audible.
Hello? Can you hear me?
Yes, we
Hello?
can. Sir, if
Hello?
you are audible to everyone, I think we are not audible to you. So, what to do?
Hello?
Aveek, sir, if you could hear us, please join again. Shashank, I am audible, right?
Yeah, you are audible. Yeah.
Okay. So Aveek, sir, please join again. There was some voice issue. You were not able to hear us. So I sent you the speaker request again. So please. You were audible till the time you were asking, am I audible? So you were audible in totality to
Okay, that's
us.
fine.
Maybe we were not audible to you.
No,
Yeah.
suddenly actually there was a noise, so and then it cut off. So I thought that I don't know whether I. So anyway, so I think you heard till the time I said, can you hear me, right? So I think then you almost heard everything.
Right.
Yeah. So when we get into the risk off mode, then we sell. We sell irrespective of whether we feel right or wrong, because at that point of time, we want to be on cash at least for 10-15%. So and as I said that we don't try to pretend that or that we are having so much of conviction that we should be writing everything. We come back immediately. We may come back and reinvest, and that is akin to, basically, I tell to investors, is akin to hedging. When you make a hedging, you are taking a cost for protecting the downside. So now just selling and buying back is a kind of a hedging. It is almost same as hedging, and maybe cost which is lower than hedging on an overall basis. So that is how we manage the portfolio. So two kind of situations when we sell it: when we find that a stock which is very well discovered, well discussed, and also in our portfolio gone up very fast, gone up very well, and showing weakness, we sell off, and we wait. We don't want allow the portfolio to remain idle. That means the stock consolidates, say, for a year after running up, and we don't want to stay back in that, saying that I'm a long term investor. I don't have any kind of particular hang up to tell the world that I'm a very long term disciplined investor. I'm a disciplined investor, but discipline does not mean that buying and holding the same stock for years. So I am having a kind of non-consensus view, but that is how we work. So, and we work very independently, and our views always form in an independent manner compared to whatever is being told and wherever it is told. So that's how it is.
Thank you so much. Just one quick, small follow-up question. Since we were mentioning about that intuitive investor book, so how do you really use this the practical knowledge of intuition that I think we read in this book into, like, when you really invest? Do you have any like framework around that?
It is framework actually vary, because I am having multiple frameworks in my mind. So point is that which framework has to be called for and which framework triggers in your mind is basically the training which you have to go through by widely reading or talking to people of similar interest. And I think there is no right answer to it. It happens. I think if you practice something over a period of time, again and again, and every day, even today, I think even today I think I read about what, maybe 15 companies conference call reports. Okay, right now, as of today, I'm talking about. Okay, so and those are not Indian companies. I was reading, all these companies are either listed in US or listed in somewhere else. So whichever has come latest, actually, like say on Q3, this Q4 results of some companies have come up. The December result for some companies have come up in US. I was just going through those. I was trying to understand what they are telling about the recession and things like that. So that is how you know that if you have a constantly you are into something, then practice, then that works out over a period of time in a manner which is very difficult to really tell that how it works.
Right. I think yeah, that's a quite fair point. So do you have any like current view to share with all of us? Like, what do you think about markets and where is India placed? Like, since you are reading so widely internationally.
I think as far as the market is concerned, I think the market will remain volatile. I think in my TV appearance also, I have told few days back in both the Hindi and English channels that market will remain volatile because three, four things are there, right? Because this money tightening is happening after almost after 2 generations. And when that kind of situation happens, it is always, market will always remain undecided about where to go. Somebody will think that this cost of money is too important a factor not to be ignored, so it is better to trim and invest elsewhere. Like now, the fixed income has also become 5-6% return you can generate out of your fixed income securities. So if a person is looking for that 6% return, he can shift from there. So there he is bearish or he is a seller in the market. At the same time, there is a thematic long-term story of India which is unfolding, which actually can take Indian growth, which can keep Indian growth at the level of 5 to 7% for a long period of time if we have a little bit of push from the government, or we have a little, we work undisturbed. Indian people work undisturbed by no external problems. Actually, uh, troubling them. And if we find that real big reforms are happening in India, like land reform, like labor code reform, like judicial reform, like police reform, like ease of doing business, actually, basically, then we can grow at 8, 9, 10% rate for many years to come, with the kind of demographic advantage we have. So that set of investors are also there. They are bullish on the market. So this kind of tug of war will continue, but the tug of war will settle by the time, I think, Fed will plateau out, because then what happens is that market will discount that particular thing. Market will already have all these negatives priced into, and will move forward from there for the next leg of events. And if you just tie it with everything else, if you see, ultimately from October 21 till today, we haven't moved anywhere. It is almost 1.5 years, right? In 1.5 years, our market are at the same top of 18,500, 18,600 level, and that we haven't breached. So market is absorbing all this news and moving around, absorbing and trying to breach, absorbing and trying to breach, and that way it is going. So I think the possibility of very big downside is low, and that is what we are telling to the investors for quite some time. I don't think that there will be an abrupt downturn in the market. Volatility will remain for another, maybe, I don't know how many months, maybe another month, 2 months. We have to see the budget, because anyway budget is coming. So there may be a budget rally in the offing, but those are small duration things. We are not much bothered about that. But point is that when the Fed ends its hiking cycle, 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 hiking cycle,